there should be a story behind this value. I cannot value Burger King just by using numbers. I cannot value a Picasso. Can I value a Picasso without telling a story? What is the value? 55 million, or 30 million, or 15 million, or any million? So we need to define what do we mean by valuation, and today I hope to show that beyond the number crunching and beyond the geniuses of all these financial mathematicians who come up with the most complicated formula, we have to stop and look behind the numbers to identify the story. The story will give us the value, hopefully. And I put today on Facebook one mysterious thing. Burger King was trying for many years to turn the business around. They came up with products, they came up with ideas, they went to different, came up with vegetarian food, they tried to convert their sandwiches into healthy food, and nothing worked. They tried many things. They were the number 2 after McDonald's, and they were trying very hard to turn around and become the number 1. And somehow, about June 2014, something happened, and the prices of their shares went to the sky. And what happened, which I didn't tell you on Facebook, was this merger with a Canadian company, and suddenly, look at the shares, how they zoom to the sky. Did you identify the reason? Did you research?
I did some research.
So what happened?
After they merged together, they were first of all competing on the breakfast.
Okay.
The breakfast area between McDonald's. McDonald's had the McCafe and Burger King.
Yes, very good.
So Tim Hortons is a Canadian company.
In the same industry.
In the same industry.
Making coffees and sandwiches and blah, blah, blah.
Its own history in those stuff. And
its own history, its own culture,
exactly. It has
its own clientele.
So when they merged together, they went to a new market, to the Canadian.
They went to a new market.
To the Canadian market, and they broadened themselves over there. So it is.
So the new market was the reason for the shares to jump to the sky?
The new market and the merger, the act of merge increased the.
How did the merger increase the value? And what do you mean by value?
The value of the company itself, I mean, the shareholder.
So what do you mean by value? To the shareholder?
Yeah.
Oh. So what does the shareholder want?
He wants more profits.
Money, cash.
Of course.
So cash is king, not the burger is king.
No.
Cash is king, okay. So shareholders wanted cash, and did they get it just because of the merger? But let me ask you, when there is a merger between two companies, did the shop change? Did the sandwiches change? Did the Burger King Whopper change? The Fritkit change?
No.
Nothing changed.
The company, the merger.
So how did the share price go up? How did the cash come from?
I think it's my personal view that investors wanted to invest in Burger King, but they weren't sure. But after they got merged together, they had it's a strong bond now. So I can put my money in.
So the shareholders became more faithful, more credible into Burger, and they invested more shares just because there was a merger.
Yes, maybe.
Maybe.
That could be one reason.
It could be a reason. I mean, we can find such stories, but in this case, there was real cash to the shareholders. Incidentally, yes, sir.
They just found a little to minimize their taxes because in Canada corporate income tax is lower than in America.
The corporate tax is lower. Tell me.
In Canada rather than in.
And how did the merger help?
They just moved the kind of legal business to Canada.
So something happened because of this merger that reduced the tax liability, and therefore the tax payment, and therefore the profits went up, so there was more cash available, yes? So what exactly happened? Do you remember? You don't remember?
So
Do you remember?
They moved the Burger King to Canada, so it's a Canadian company rather than...
Well, they didn't move it physically, but the registration moved, and therefore for tax purposes,
It's only the Canadian...
for tax purposes, Burger King became Canadian. Yes?
Yes.
But by being Canadian, they avoided, please be careful, I didn't say evade, I said avoid, right? They avoided a very clever tax trap. US companies who have operations abroad, obviously their profits abroad get taxed. But when the net income comes to the US, it gets taxed again. So by registering with a Canadian company, they register themselves in Canada. For tax purposes, Burger King is not a US company, for tax purposes. And therefore, this double tax was avoided. And therefore, more cash remained for the beautiful shareholders. And therefore, price went to the sky. So with this tax inversion trick, Burger King was able to increase value, not to you, not to the clients, not to the staff, not to the banks, not to the lenders, not to anybody else, to the shareholders. And therefore the price of the shares went sky high. Okay? Nothing operationally happened. Okay? Which was very good. It was very clever. The advert that we saw, or that we didn't see, was an advert trying to convince the audiences that now we have a better, healthier, bigger, more beautiful burger. It's not what you thought. It's not as bad as you thought. It's much better than you thought, blah, blah, blah. It's healthy. It's vegetarian. You have a choice between meat and fish and vegetables, blah, blah, blah. That never helped increase the value to the company. The real cash did. And we move on. Bayer, Munich. Look at the shares going down. The value to the owners has been falling. Remember some time ago when Lewandowski scored 5 goals in one match in some 10 minutes? In 9 minutes, sorry. Someone is correcting me. In 9 minutes, Lewandowski scored 5 goals. I mean, that was a historical event, right? Wouldn't that drive the value of the club to the sky? 1 week ago, they beat Wolfsburg 6-0. Lewandowski scored 2. Wouldn't that, I mean, wouldn't such things, this is the second goal of Lewandowski, wouldn't such things increase the value of the club? I mean, isn't this what this is all about? Such sins would not increase the value of Bayer. So what happened? Why are the shares not performing as well as we would expect, as I would expect? because I'm a Lewandowski fan. Look at this. What's Bayern there? Bayern is number 1. Same period of time. But there, Bayern is number 5. Oh my God. What's going on? It's very simple. Different consultants use a different valuation model. To value a club is not easy because not many clubs are listed on the stock exchange. You don't have all the information. And the way you relate finally to the revenue, to the net profitability of the club, is slightly complicated because it depends a lot on emotions. It depends on how you perform on the pitch. It depends on how you turn around the team, which player you buy and sell. So for example, Arsenal, you know Arsenal? When their player reaches the peak, they sell the player to make money, which means that they have to have a process by which when the player reaches the peak to be sold for money, another player is coming behind to perform as well. Sometimes players get sick. Can you imagine what will happen to the shares if Lewandowski goes sick just before a very important match? So the value of the share during that week may behave differently. They relate value to performance on the pitch, the combination of the football team, the kind of contracts they have for licensing, for t-shirts, for adverts with airlines, and different valuers will use different indices, different formula, different percentages of each one of these factors, and therefore the value they arrive at is different. And they confuse all of us. So whether you are looking into Morningstar, or whether you're looking into brand financing, or whether you're looking into Forbes, they will give you a different valuation model and a different value for the same share. So if you are going to be valuing or giving advice for valuation, you need to know what you are doing. You should not rely on any of these models. How many valuation models do you think? How many do you know, valuation models? If I put them on a list, these are my notes, by the way, I would need to have a few meters list of valuation models. There are many. Some of them are simple, some are more complicated, some are very complex, some nobody knows if they make sense, but there are many valuation models. And to approach valuation, there are only two approaches. Either you look at the fundamentals of what you are valuing. What is this thing? How does it generate value, whatever that value is? If it's cash, then how does this generate cash? How do we measure it? And the other is relative. So you go and you look into the value of something which is already valued. Maybe it's been purchased yesterday, So if you're going to buy a flat, anybody bought a flat? Have you been involved in buying a flat for someone? Yes? So what do you do when you buy a flat? You need to go and look
Just look around
in the same neighborhood,
the same area.
what has been sold, at what price this was sold. Maybe it's the right information, wrong information. Is it the same number of square meters? Is it facing east, west? Is it sunny? Is it not sunny? Yeah? Big windows, small windows. So you try to find a relative way of comparing to what you want to value. And usually what happens, we just believe agents, what they tell us. They tell us, blah, 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 the value is so much, 100,000 zloty. Oh, okay. The agent said so. So we buy it. And when we buy it, that is the real value, because there is a transaction. We paid 100,000 zlotys, and that's it. That is the actual value. And when we actually pay, it becomes a value in the market, then the next buyer will use that 100,000 to value the next transaction. But it doesn't matter, it doesn't mean that the value is correct. The price is correct, because that's what we paid for, but pricing and valuing are two different things. Okay? You may buy a Picasso for 15 million because you have emotional interest in that painting, but it doesn't mean that the value is 15 million. Okay? Value for whom? And value when? And why are we valuing this Picasso? For what reason? Okay. Oh, yeah, maybe there is a third approach to valuation, which is the option pricing theory. But let's see if we can discuss it later if we have time. Now, we have been looking, remember, this valuation indices. They are actually the PE ratios. I'm sure you know what is PE. Do you? What is price earnings ratio? If you go to a stock exchange, the one single most popular index which is being used to value a share on the stock exchange is the PE ratio, price over earnings. Price is very simple. What is the price of the share today? It's not so simple, because when we say price of the share selling today, but who is buying this share? Because the stock exchange is a secondary market. There is a huge amount of shareholding, but maybe only a part of that is being traded. So if only a small amount of that shareholding is being traded on a daily basis on the stock exchange, is that price relevant? And does it reflect the actual value of the share? Now, if most of the shares are being traded on a daily basis, then yes. Then we can say with some degree of certainty that that price reflects the value of the share today. But it's not always the case. But anyway, let's assume that that price does reflect. Price, why do you think people buy shares? Because they love Bayer, because they love Burger King, because they love Amazon, why do they buy shares? Why do investors buy shares?
Profit.
When?
After their prices gets high, after their value gets higher, I can sell them for more than I bought. So
in the future?
In the future.
So price looks into the future. So we are looking into the future. Now, price will go up. When will price will go up?
After its value gets increased.
when do you think the price of a share will go up? When what? I mean, typically a shareholder gets what from a share every year? A dividend. So if you project dividends in the future, you invest in that share to earn dividends. How much are you willing to pay for that share? More or less than all the dividends you expect to get in the future? Preferably? More? Less. So preferably, you'll want to pay less than what you expect to get in the future, correct? And the guy that sells the share to you, he or she are giving up the future dividends. So preferably they would be willing to sell to you at a higher or lower price?
For them? Higher.
Higher price. And the two will reach an equilibrium, correct? So we assume that the price on the stock exchange is that equilibrium. We assume. It may be not. It may be near, it may be far from the equilibrium. But this is the assumption we are making. So price is something in the future. Am I pointing in the right direction? No. In the future, right? However, earnings. What is earnings? What the company has earned on behalf of the shareholders, not the total revenue, but the net income, the net revenue, which is available for the shareholders. But this earning is only what we recently computed in the income statement. So earnings looks into history. So we are comparing future with history to come up with what? With a multiple, we call it. What is a P? What's price over earnings? What does it give you? Dollars, euro, time, years, months? Value? Price is in dollars. Earnings is in dollars. So when you divide dollars by dollars, what do you get?
It's the year to get back our investment.
It is the years
To
that you need
return the investment.
to get your investment back. Okay, I mean, absolutely correct, but I prefer to call it the number of years that you think the company is able to pay you those earnings. And the higher the P/E ratio, the better?
No.
No. Oh, I thought the higher the P/E ratio, the better. So if the P/E ratio is 1, it's high value? I'm confused. So P/E ratio is the number of years that we need to get the investment back. So the lower the P/E ratio, the better. Ooh. Let's go back. Let's go back a bit. Let's go back a bit. After the merger with Burger King, this orange is the Standard & Poor's index for the 500 best performing shares, and this is the new merged company. That's the P/E ratio, which drove the value of the shares to the sky. So the higher the P/E ratio, the higher the value of the share. So if the P/E ratio is 50, it means that I need 50 years to get my return. If it's Amazon, which is 700, I will not live long enough to get my investment back. Oh my God. Something is confusing. This is the problem with the numbers. And this is why we need to know the story and not just to know the numbers. If we don't know the story behind the numbers, then we don't know how to value. The assumption is that the higher the price, the more the years there will be, and the more confident I feel that this company is able for the next 50 years to give me this return. Do you see how I am translating? I am not saying it will take 50 years to pay me back, because really tomorrow I can sell it. I can sell the share and get everything back. But what I am saying is this company has the operational ability for 50 years, in the case of Amazon, for 700 years, to pay me this return. That's a strong company. Tak? So the story is important, and the concept, and I know in most of the books, this is what they say. In most of the books, I didn't bring my books with me, but I can show you huge McKinsey and EY and KPMG books and valuation books. This is exactly what they say. The number of years that I need to get my investment back. No. It is the number of years that this company is able to pay me these earnings. So the longer, the stronger. And if I want all the investment back, tomorrow I can sell it on the stock exchange. Do you get the message? We move on. So, price, you look into the future. Earnings, you look into the past. You mix them together and you make a mess. Right? So, really, what should be done is to look into the future to determine the price, and to look into the future to determine the earnings. And then we are talking sense. But how many people do it? Not many. So we have to be careful. As I said, be careful, right? Exactly what we discussed, blah, 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 because of this confusion. All right. Let's do a small case study. There is a company called OMC, private limited company, performing very well in the recent years, 10 years. Very strong competition in the market. And the board of directors have a proposal from another listed company to be merged, to be taken over effectively. And therefore, you have been asked to advise the board on the value of this company, which is about to be sold. Okay? I mean, why do we value anything? Either because we want to sell it, or because we want to liquidate it, or because we want to merge, we want to make an agreement with someone. In this case, there has been a proposal to merge. Therefore, the board of directors of OMC, I will not tell you what OMC means, it's a secret, wants you to value their shares. So you ask for information. Obviously, the number one thing you will ask for is the financial statements. Why? Because it's the only one thing which is tangible, it's there, it's available, it's audited, preferably by EY. Don't give to other auditors because you cannot feel confident that the numbers are right. Do you know what is an audit opinion? Audit report? Company issues financial statements. The auditor comes to audit. What is the output of the audit process? What happens at the end of the audit?
Generate the report.
Sorry?
Generate the audit report.
It generates the audit report, which says what?
It says the financial statement shows the fair and
A free and true and fair view.
true and fair view.
Hold on. It doesn't say the financial statements present a true and fair view. It says something more important than that. In our opinion, the financial statements presented. Whose opinion?
Audit.
Whose? Some individual? Some? Don't ask me. We don't know. But be careful, okay? So you have the balance sheet. In this balance sheet, you see fixed assets, which maybe represent the stadium of Bayern or the restaurants of Burger King or the shops of Amazon or whatever. Current assets, which include cash, current liabilities, obviously. You've seen balance sheets before, yes? Okay, so this is the asset side at the top and the liabilities and capital at the bottom. Reserves means what? Reserves, it's not reserva in Polish. Reserves means profits, accumulated profits. They have not yet been distributed. All right? We keep them until later. Why do we not distribute all the profits? Why don't we distribute all the profits? First of all, any profits we make belong to whom? Shareholders. Why are we keeping them? Why are we not distributing the profits? We do three things with profits. 1, 2, 3. 1, we pay dividends. How much do you pay out as dividends? How much? Tell me the story. Don't give me numbers. How much dividend do you pay shareholders?
It depends on the dividend policy.
It depends on the dividend policy, yeah. So how much do you pay? How much would you pay shareholders as a dividend? All of the profits?
Of course not.
Why not?
We need the money to expand our business.
Oh. So how much do you pay them? Just enough to keep a small smile on their face. Just that much. If it's a big smile, you have given them too much. Okay? So give them just enough to keep their investment with the business. Second reason, so this is reason number 1. Second reason, we do what with profits? You said it. We keep it to invest. We need to invest. Guys, a company that does not invest, what happens to the PE ratio? Why? Because when you look into the future, what do you see? Not much. But if you invest, at least you are telling the investors, you know, something will happen in the future. Okay? And number 3? Number 3? So this is for investment. Number 3?
To maintain the business.
You maintain the business, that's cost. You deduct the cost, you are left with profit. What else do you do with profit? No, that's investing. Yeah.
Expected losses.
Expected losses, that's the investment. But I like that, expected losses. So what happens when you have loss next year?
No, I'm talking about unexpected. If you
No, stick to the losses. You make a loss next year. What is your problem? You made a loss next year.
and
What is your problem?
I need money to
To?
cover my loss.
No. You made losses. You need money to pay those shareholders a dividend. Because if you pay shareholders a dividend in 1 year when you have profits and you don't pay them when you have losses, how is the market going to perceive your share?
They will sell it.
When in 1 year you give dividends, in another you don't, in another you do, your share is? What is the number one thing that an investor is worried about?
Stability.
Which means? Stability, which means? Come on, give me that term.
Volatility.
When you invest, what are you worried about? Why do you put your money in a bank and you don't give it to Marinos? Risk. What does risk mean? Volatility, as you said. Don't confuse risk with profit and loss. Risk is up and down. If the investors know that you are up and down, your share is perceived as risky, and when the share is perceived risky, its value goes to the bottom. So to avoid this perception in the market, the management of any company will try to maintain stable dividend. Year in, year out, year in, year out, preferably slight increase over the years. To be able to do that, in good years we keep some profits, and in bad years we take them out and we pay dividends. Okay? So this is risk management. Risk management. Okay? This wasn't part of the presentation, but I'm glad I have done it. So you have the balance sheet, and you also have the income statement. Thankfully, we have done well, and we have some profit. 125 million as a profit. Our gross profit is even healthier. What's the difference between gross and net? What different signals does the top and the bottom give you?
Taxes.
Sorry?
Taxes utilization.
Taxes. Okay, so what does the 550 show you? And what does the 125 show you? What does the 550 show you? The ability to acquire resources economically and sell them effectively through an efficient process. So you buy cheap, you sell expensive. That's the operational ability. And after that, if you are able to avoid taxes, if you are able to pay the management less, if you can avoid expensive, handsome secretaries and red carpets and expensive traveling, this will show how you manage the overheads of the enterprise. So that gives you operational strength, and this gives you an indication on cost management of overheads, which is very important, because in both you get cash flows, and cash flows will drive your P ratio higher. Okay? So you have this information. Do you have a pen or something? And we are going to value, based on this, we are going to value OMC using the financial statements. Obviously, the book value of the assets is 2.050 billion. Is that correct? Yeah. It's 2050 million. Liabilities, if you add them together, they're 150. So the net book value of the business is 1 billion. How happy are you with this valuation? Does this value look into the future? So what you did effectively, you put all the buildings of Burger King, the stadium of the football club that you're valuing, the equipment probably, if you have expensive equipment. Probably in there you have the brand value of Lewandowski. Yeah? You know what is brand value of Lewandowski? If we pay Lewandowski 100 million to stay for 5 years, this 100 million doesn't show as a cost in the income statement. The 100 million that we have contracted with Lewandowski will not show here as a cost. I will spread it over the 5 years. So in the balance sheet, I will have in the fixed assets one major part of that 100, maybe 80 million, will be capitalized to be depreciated in the next 5 years, 4 years, or whatever. And if Lewandowski goes sick, or if Beckham, do you remember Beckham? You know Beckham? You know what happened in Manchester United, Davno Demo? Behind, after the match, he had a fight with Alex Ferguson, remember? And from that day, he never went on the pitch. So what happened on that day? What happened to all the brand value in the fixed assets? It was taken into the income statement as a cost immediately. So the balance sheet shrunk. If a football player falls sick, all those millions that show as fixed assets will disappear. And the shares will go down. And that player will be replaced by a new player who is a kid, young, doesn't have a brand value, nobody knows if that guy is going to perform, blah, blah, blah. If Burger King does a tax trick and suddenly has billions available, the balance sheet is historic. So this historicness of the balance sheet and the financial statements is very worrying. But is it historic? Look at the definition of an asset. In international financial reporting standards, in US GAAP, in Polish accounting law, Israeli Accounting Act, German Accounting Act, almost everywhere on the planet, when you show an asset in the balance sheet, it's meant to be a resource, which is correct. An asset is something we use to generate income. We work on the asset. If you are a shopkeeper, you need shelves, you need a van to go to the market to buy vegetables. You need a stadium if you are a football club. You need a restaurant if you are Burger King. So it's a resource which is controlled by the enterprise, not owned, controlled, as a result of past events. So something must have happened in the past to be able to say, I have an asset. You cannot look into the future and say, I will have an asset and I show it today. No. Something happened in the past. You bought it, you built it, you hired it, you listed it, you smuggled it from Russia. Something happened in the past which gives rise to the asset today. So you can say, I have this asset which will generate cash flows in the future. You cannot say, I will have an asset, ladies and gentlemen of the shareholding, I will have an asset tomorrow, so here it is, I value it today. There is no such thing. So it's something which exists today, and from this asset, we expect future economic benefits. Future economic benefits. So what this is saying, actually, is that accountants look into the future, they estimate the benefits arising from this asset, add them up, preferably discount them to the present, find the present value, and this is the value that goes in the balance sheet. So, Burger King bought a restaurant for 100 million, and we ask the management of Burger King, what value will this restaurant generate? So they sit and they make the numbers and the calculations, and they come up with 10 billion. Cash flows will come out of this restaurant. So the 10 billion should go in the balance sheet. Do you agree? Can I show in the balance sheet 10 billion? The cost of the asset is how much? 100 million. Yeah? I expect future economic benefits, all of them discounted to the present, will be 10 billion. Can I show 10 billion in the balance sheet? The answer is yes or no. You have 50-50 chance. This is ACCA examination. Yes or no? In ACCA exams, by the way, if you do have multiple choice, don't leave questions without answers, because you don't get penalized. If you don't know, just put an answer. Okay? Because you don't get minus points. But anyway, can I show 10 billion in the balance sheet? Because some professor will tell you it's cost minus depreciation, yeah? Do you remember this? Cost minus depreciation? The answer is no, you cannot show 10 billion. But what's wrong with the definition? Nothing is wrong with the definition. It's a beautiful definition. It's an absolutely beautiful definition. It's saying, ladies and gentlemen, I acquired this asset, it cost me 100 million, and I will expect 10 billion cash flows. And I'm giving you this information. It's very useful, economic, clear, precise information. However, I cannot do it. Because unfortunately, also in accounting, there is a concept which we call prudence. Do you remember prudence? Do you remember? What does prudence say? Anybody knows? Prudence says, look into the future, and if you see profits and income, take a cold freezing shower, freeze, relax, and do nothing. But if you see losses, run quickly to the accountants and tell them to write them off. So if I look into the future and I see that the brand of Lewandowski Niepodległości, because Lewandowski is sick, or because he had a fight with the manager, I have to remove from the balance sheet all those millions and reduce the profit in that year, immediately. But if I look into the future and I see profits and income, I do nothing. Prudence. I have to be prudent. And the reason is obvious, because we don't want to manipulate the numbers. Okay? So unfortunately, whatever you see in this 1 billion is just the book value of the balance sheet. And we move on. Let's get some more information so that we can effect a more complex valuation. OMC Limited was capitalized with 40,000 shares, 20 euro each. A similar company to OMC was selling its shares for 75 recently. The weighted average cost of capital, do you know what that is? Capital contains two elements: equity from the shareholders and borrowing, debt from the venture holders, maybe loans from banks. All right? What's the difference between the two? What's the difference between equity and debt?
Debt is cheaper
Debt is cheaper. Why is debt cheaper?
because we don't have to pay it constantly. And also,
No, you have to pay every year. Every year you have to pay interest.
the interest is tax deductible.
Interest is tax deductible. Brilliant. So that makes it cheaper, definitely. Anything else? Why is debt cheaper than equity? What do you pay shareholders? Dividend. Do you have to pay them? Do you? Do you have to pay shareholders a dividend? Is it a must? Do you have to pay the debt holder? Do you have to pay the loan? Yes. You have to pay the loan interest, yeah? Every year. Oh my God. Okay. So if you don't pay, what happens? They so they have a charge on some asset. Maybe on the building, maybe on the stadium, maybe on something on the stock. Aha. So if I don't pay the debt holder, then they will take my asset, which means that they have a charge. And because they have a charge, they are more secure than the equity holders. Aha. So because they are more secure, the interest is lower. The equity holders have zero security, therefore their return is higher. Okay? So for two reasons. Because debt by definition is cheaper because they have security and the risk is reduced. But because of the tax, in countries where there is taxation, then the tax shield, as it is called, makes debt cheaper. Okay. So companies usually have both equity and debt, and we need to average out what the return on this capital is, which is the WACC, which is the cost of financing the business. And this weighted average is 10%. The dividend growth of OMC is 5%, hopefully. And the company is hoping to grow its revenues at the rate of 15% for the next 3 years, and we are being prudent. We expect more, but we are trying to be prudent. So how would we value using the dividend valuation method? Now, the dividend valuation method tells me, look into the future, estimate the dividends accruing to the shareholders, add them up. It's very similar to this, isn't it? It's very similar to this. Estimate the dividends that will be coming through. Add them together, preferably discount them to find the present value. And that is the value of the share. You shouldn't pay more than this. Maybe less, but not more. Okay? Now, when you go home, I want you to sit down and prove this formula. All right? The present value of the future dividends is next year's dividend, D1, because now it's times 0. So D1 is next year's dividend, divided by the discount factor. K is the return to the equity and debt, the cost of capital, minus the growth rate. It's very easy to prove, and I want you to sit for 10 minutes and prove it to yourself. You know geometric progressions? You know Gauss? You know arithmetic progression? You know geometric progression? A plus AR plus AR squared plus AR to the cube plus AR to the fourth. How to find the summation of this geometric progression? This is what this is. Okay? And it comes to a very simple, beautiful little formula. And if we do that, oops. This is the P. Hold on. Okay, I didn't. Yeah, I will show you later. So this is the dividend valuation. The P, we will look into another similar company. What does similar company mean?
Same industry, same structure.
Maybe in the same industry, hopefully. Same size. Same structure of capital. They have the same structure of equity and debt, because if they don't, the cost of capital will be different. Yeah? And therefore the value will be different because of the taxation, because of the lower interest. So try to find a similar company. And where are we? So, and the price of that was how much? 75, yeah? A similar company was 75, remember? This was in the additional information, yeah? Do you see that? A similar company, blah, 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 had recently sold shares for 75. So we take that to be similar price to ours. Find the earnings for each of your shares. Your total earnings, remember, was 175,000. Do you remember? Your earnings were 175. You see? There it is. In that year, you generated 175 for the shareholders. Of course, you paid them 50, but we don't care about this. We care about what we generated in that year for the shareholders. Divide by the number of shares, and you have the 4.3 is the earnings for each share, because you have 40,000 shares. So take that 4.3, and that's your earnings. Price divided by earnings is 17. What is this 17? Tell me, what is this 17? Is it dollars? Is it miles? Is it kilometers? Is it... What is this 17? What am I dividing? Price, dollars, divided by earnings, which is also dollars, or euro divided by euro. So it's years. So this is the number of years. For 17 years, I will be earning this earning. Okay? The company can maintain for 17 years, pay me this return. Okay? So this is the P/E ratio. And multiply the 17 with the 5.03, and then you have the value of the share in the market. Now, is this a true value, whatever that means? Is it a real value, whatever that means? It's a value. But what we are going to do, at the end of the day, we are going to list them and compare them. We used the financial statements, we came up with 1 billion. Dividend valuation, with this little simple formula, if you put the numbers in, it will be more or less 1 billion as well. P ratio, 3.5 billion, huge difference. Or the capitalization. What is the market capitalization of this? The value is 75, the number of shares is 40, the total capital value is 3 billion. What assumptions am I making? I'm saying, well, another company is like mine, so 75 is a fair value of the share. I have 40,000 shares. There you go. Well, if you had 100,000 shares, because you can issue shares at any price you want, yeah? Instead of 40,000, you could issue 80,000 at half the price. So it's a bit strange. The reason I'm doing this is to show you that no one can tell you how to value. There is no valuation model which is correct. Okay? Strong message. There is no valuation model which is correct, and there is no way to test a valuation model. Because if I decide, okay, I have value today, after 3 months I will see if the value is correct. Time has changed, conditions have changed, the phases have changed. There is no way I can test. Okay? By the way, I have to watch the time. We finish at 1:20? Remind me. 1:20? Very good. Excellent. So, let's move on. I want to discuss the P ratio because if you move into finance, everybody will be talking to you and expecting from you to play with the P ratio, price over earnings. Okay? Now, one simple example. There are two companies, A and B. They make the same income. They are the same size. They have the same kind of assets. They generate the same revenues. They make the same profits, 100, 100, 105, 105. Easy? Easy. The same companies, I look at their cash flows. What do I see? Company A depreciates 200, yeah? Do you see that? However, Company A buys the machinery in advance, 3 years in advance, and depreciates over the 3 years. But Company B, same depreciation, but they buy more often. The capital expenditure is not 600 at the beginning of the 3 years, it's 200 every year. They lease, they hire the equipment. Which company pays cash today and not tomorrow? Company A buys today for 3 years. Company B buys 200 every year. Company A has customers that owe money to Company A, less tomorrow, but more today. Whereas Company B, clients owe, you see, 150. You see? 250. So company A forgets to invoice clients. Company B is chasing the clients to pay. So company A has overdraft to start with, huge overdraft, and the cash later. Company B has almost zero overdraft. Yeah? Do you see? And cash upfront. So which of these two has more value? Which of these two has more value? The company that pays more cash today or the company that pays tomorrow? B. B should be more valuable. If you discount the cash flows to the present value of B will be bigger than the present value of A. But if you use the P ratio, the value is the same. Because the earnings, what is this earnings? What do you see in earnings? You see chaos. You see a burning universe. In the earnings, you have things like this. This is time 0, year 1, year 2, year 3, year 4, and so on and so forth. Today, we sell 100 million. We sell for 100 million income. In year 3, so we have 100 net income, yeah? In year 3, a client who owes us 15 million has gone on a permanent holiday in Honolulu and will never come back. We cannot chase this client, so we have lost 15 million. This 15 million, you agree with me, is a loss. It's a cost, right? Do you agree? We've lost this money, right? When are we going to show this 50 million as a cost in the income statement? In which year? Sorry? In the third year. Is that matching apples with apples or matching apples with oranges? It's matching apples with oranges. The cost of the 15 million is a cost which relates to year 1. So I should show this in year 1. And not in year 3. But how can I know that this will occur in year 3 to show it today? Well, you have to look into the future. You have to estimate. You have to create a provision for bad debts. It will not be absolutely correct, but year after year you'll be adjusting. So you have to always look into the future, estimate costs which relate to now, and show these costs now. So when we say estimate, it means judgment. It means mistakes. It means maybe manipulation. It means difference in opinion. So when we look at earnings, I don't know what this earnings figure contains. Is it good provision for bad debts? Is it good provision for obsolete stock? Is this estimated by someone that really knows the business? Was it manipulation, incentive maybe? But when I see cash, it's cash. Right? So when I see net income and P ratio, I get scared because I have no idea what's in that earnings. But when I see cash, I feel better because cash is cash. Right? Very good. Look at Facebook. Going back. Look at the valuation, the P. Facebook has been chaotic. Do you remember what happened when Facebook went listed? Do you remember? Was it under or over valued? Do you remember? You don't remember? Ooh. It was overvalued. I mean, the guy made a lot of money, but many investors lost money because they overvalued Facebook. And I mean, imagine how such experts can not only go wrong, but also they lose quite a bit of money. And one interesting bit was that before the IPO, there was a comment that of all the things discussed and analyzed surrounding Facebook's upcoming initial public offering, probably the most surprising is the co-founder. He came to talk to the prospective investors, and he came in his hoodie. And there was confusion in the market because he came to talk to the people that were going to give him billions, and the market thought that he didn't show the right respect to these investors. The representatives of the hoodie guy said that no, Mark is going to stay what he is and he's going to represent the company, he's very respectful, blah, blah, blah. But already there was uneasiness amongst the investors, and it's the investors, the pension funds, the trust funds, the banks, they started feeling uneasy, but we will never know if that was one of the reasons why the shares went down or whatever. But I just wanted to communicate to you, we need to look at the story, not only the numbers. Amazon, my God, Amazon is a great story. Amazon is the company that invests year in, year out. They show innovative ideas. They keep informing their investors what they are about to do in the future. Their shares, look at their shares. Look at the 500 index. Look at the 500 index. Yeah? I mean, in 2013, the shares were 1,400 years. Okay? I mean, this is the P ratio. I mean, investors were willing to buy these shares because they had faith that for 1,000 years Amazon will be paying them. Okay, later they cooled down, and now the share is standing at about 175 years, which is the highest that you can find ever. 175 years, I mean, nobody will live that long to get the investment back. Correct? Now, let's stop talking about calculating value, but how to make value. How is value created? We saw one brilliant example in the morning, 1 hour ago, with Burger King, tax inversion. That was a real creation of value, real cash. That's creation of value. What else can create value?
Expanding other markets.
Expanding in other markets, assuming you made a net profit and you keep adding this net profit on the existing, then yes, that will add value. What else? I have a list there. You know what is EEE? This is your company. These are your operations. You need inputs so that something happens to those inputs, and you have output. Your inputs must be economic. Your process must be efficient, and your output must be effective. If you can improve the process, so for example, you are in a factory and you observe that they keep moving raw materials from one corner to another, and after 3 hours they move it again because of bad planning, and you have to pay people to move them around, the raw materials. So that's a wasted activity. It's redundant. If you can identify redundancies in the process and you remove them, the value goes up. So if you can improve the process and make it more efficient, you gain value. If you can strike better relations with your suppliers, like BMW, they store nothing. It's just in time. They have such excellent relations with their suppliers. They are like a part of BMW. So at the moment they need a part, it's there at the door. So they save on space, they save on labor, they save on administration, they save on all sorts of things. Similarly, if you know what your client wants, and when we say client, we don't mean another company, within the same company. If your group knows what the next group wants to do their work to produce the product or the service, you provide what they need so they don't have to redo it, and you save money. And this is actually known as value-based management. So we don't manage by departments, we manage by process. And if each process has an owner, which is very important, then that process will be looked after, will be re-engineered, and it will work EEE. Okay? Tax we discussed, and the cost of the weighted average cost of capital, the WACC. Why is that important? Obviously, the lower the cost of capital, the more cash is left over. Now, we said that debt is constant, so much interest per annum. But dividends, the cost to equity, is increasing with gearing. This is gearing. What do we mean by gearing? Gearing, we mean more debt. One definition of gearing is debt over equity. The more debt, the higher the gearing ratio. What is this gearing? Now, the more the debt, the cheaper the average cost of capital, yeah, because you combine. If you start 100% equity, you pay only dividends to finance the company, and then you start replacing with some debt, the average of the two will start falling, right? Because you mix expensive with cheap, so the average will be cheaper than yesterday. But can this go on forever? What happens when you increase gearing? The debt holders will not want more. What happens when you increase gearing? You know what is a business cycle? Business cycle. Right? During good times, everybody's happy. Shareholders receive their dividends, The banks receive their interest, the debt holders receive their interest, everybody's happy. During bad times, they are still smiling, the debt holders, because they have a charge on your assets. Remember? They have a charge on your assets. So they know they will get their interest. But the shareholders, oops, what have I done? But the shareholders are not smiling because you don't pay them dividends. So the more debt you have, the more the risk that during bad times you will not have enough money to pay the dividends. And if your share is perceived risky, its value will go down. So the higher the gearing ratio, which represents financial risk, the higher the gearing ratio, the lower the value of your share. So you have to strike a balance. On the one hand, more debt will reduce your average cost of capital, which will increase your revenues, your available cash. But on the other hand, you have to be careful because it reduces the value of your shares, and therefore the investors will be less willing to invest in your company. Excellent, which means I have 10 minutes or so to talk to you about the ACCA, but are there any questions on valuation before we move on to a... Yes, ask.
Regarding Snapchat, do you think it's a good idea?
Sorry, regarding?
Snapchat, it's in a war right now with Facebook.
Yes.
Do you think that if it merges with any other company, like what Burger King did, it would gain their market again, or...?
We need a lot more information for that, and I have no idea if they will get a new market or not, but if they do, then yes.
Because Facebook, bought previously Instagram and bought WhatsApp, Mark Zuckerberg bought WhatsApp, and he's trying to fight with Snapchat over the story thing, so that now Facebook story we have, Instagram story we have. Even WhatsApp.
Okay, this is a good question, and my answer is that I cannot be a prophet. And this is one big danger. If the market believes what the stories are, if the story is made up and we believe in the story, then the shares will go up, because everybody will be looking into the future and they will be seeing benefits, cash. Then the P ratio will increase. But whether the story is true or not, we need a lot more information, which I cannot have now. Okay? But look at the story carefully and make sure the story is reasonably correct. Any other questions? Valuations? Okay. ACCA. What is ACCA? What do you think ACCA is? What do you think ACCA is? Any, Buster, how do I go back? I want to go back to show you what is ACCA. Okay, very good. What is ACCA? Here is Burger King. Oh, you don't see anything? Oh, brilliant. I have no idea why you don't see anything. I haven't done anything. But it's brilliant that you cannot see anything. Does anybody...
I know, you have a green whiteboard, so we can use...
I have a whiteboard here. Okay. Very good. Thank you, Gosha. So here is Burger King. You see Burger King? And Burger King is an entity, a company, surrounded by stakeholders. Give me some names of stakeholders quickly.
Employees,
Shareholders, employees,
government,
the government, suppliers, customers. And these stakeholders, they want something. Employees want holidays, money, good, whatever. Shareholders want dividend. The banks want money. Suppliers want payment yesterday. The customers don't want to pay, blah, blah, blah. Yeah? Now, management of this entity has to keep the stakeholders smiling. If they are not smiling, then we are not doing well. Okay? To keep them smiling, management will come up with goals. We want to be number one. We want to be the healthiest burger on the planet. We want to be the richest. We want to be the most clean. We want to something. Yeah? There are some goals to be achieved. These goals need to be translated into smart objectives. What do you mean by smart? Well, I want to be the rich or the most profitable company is one thing, but I want to make 15 billion profit every 10 years, or every year, or every month. It has to be specific. What are we talking about? It has to be measurable. It has to be making sense and realizable within a reasonable amount of time. I mean, I drink 1 bottle of wine every 3 months. Yeah? I have a special way of pumping out the air, making it vacuum, and I drink a little bit every 2-3 days. In 3 months, I consume the whole bottle of wine. But drinking a bottle of wine every hour is different from drinking a bottle of wine over 3 months, right? So the goals must be translated into objectives, into smart objectives, and this needs to be translated into collection of data and analysis to give you a selection of strategies to choose from. And the strategies are what to actually do. To do the Burger Kings, to find restaurants in this country, in that country, to strike contracts with owners of the restaurants, the royalties, and all that. Once you have the strategy, then you start the operations. And hopefully, you monitor the results. And you measure them, and you find the variances, and you go back to see and compare. Do I have the right goals? Do I have the right stakeholders? Do I have the right objectives? Is the data correct? Are my strategies the right ones? My operations maybe need fixing, as we discussed earlier. Maybe my costing, budgeting system needs to be more sophisticated. What are we looking at? What is this? This is the management process which you see in your books every day. This is the planning stage, planning. This is the decision making. And this is the controlling process. The management process. This is ACCA. When you do ACCA, when you qualify ACCA, you go through everything of this. Why is this important? What can go wrong somewhere there? Something may happen or something may not happen at some point there, which will lead to the non-fulfillment of the SMART objectives. And if we don't fulfill the SMART objectives, they are not smiling. Who are they? Do you like Burger King? How much value is Burger King? 100, 90, 80? Do you like Hopper? How do you rate Burger King? Who doesn't like Burger King? Who doesn't like bad food, Burger King? Do you love Burger King? You don't like Burger King?
I like it,
But
it's fine.
Burger King has not identified you to be a client. So when we say value, to whom? If you are not an identified client to Burger King, then you have no say in this. All right? So, for example, taxi drivers can go on strike. Can they? No, pilots can go on strike. No, doctors. Taxi drivers? Have you heard taxi drivers going on strike? So who do we care most from this? Who are important? Which stakeholders are important to us? The key stakeholders. And you are not a key stakeholder because you are not identified to be one. So the key stakeholders that exert an influence on the decision of the enterprise, it's them that we have to keep smiling. So when you do ACCA, you will do accounting, financial management, law, taxation, tax planning, internal, external audit, controlling of the business, sophisticated budgeting, process management, marketing strategies, IT strategies, whatever is there. Unfortunately, in the Anglo-Saxon terminology, we say chartered accountant, certified and chartered accountant, but we don't mean accountant. When we say ACCA member, a member of the Association of Chartered Certified Accountants, we mean Grupa Riba. We mean a professional decision maker. Now, they got the name accountant because the language of business is accounting. But when you do ACCA, you don't do just accounting. Accounting is only one part of the whole qualification. All right? Someone asked me once, Marinos, why should I not do an MBA? I said, which MBA? Which university? What syllabus is in this MBA? Which country, which language, which accreditation board? There is only one ACCA. There are many MBAs. There is only one ACCA. Secondly, you become a member of an international association, not an alumni of 50 students in the MBA. And no matter in what industry, country, region you work, you always have the local support of ACCA. So this is the difference. Exams are not easy, because if exams were easy, everybody would be an ACCA member. So this is the trick of the trade. I strongly suggest that if you come to this program to do ACCA, you are going to spend 2 years seriously studying to get through ACCA. If you think that you have a difficult partner, or your dog needs walking every day, or if you don't think you have 2 years to yourself, because once you start failing exams and postponing taking the exams, you never finish. So if you're determined to come, spend 2 years, study, and pass ACCA, then come to this program. I'm sure you have questions on ACCA. You had no questions on valuation, but on ACCA? Have I answered your questions, or did you want more on ACCA? You're okay? Yeah?
What's the next step?
What is the next step? I have no idea. Gosha, what is the next step?
No, I need the next step after ACCA.
When you finish ACCA,
Yes.
the limit is not even the sky. The limit is not even the sky. You can go beyond the sky. And I don't have to answer this question because you become an ACCA and you will not ask this question.
No, but actually, yes. I'm not a member, yes, but I passed all exams.
You passed all the ACCA exams?
Yes, but
So the next step is to go and do your practice to get your qualification. This is your next step, if you passed all the exams. You passed all the P1, P2, P3,
yeah.
all this? So you're an affiliate of ACCA?
Yes, and I have like 1 year experience, so we still have to.
So you have to wait for another 2 years to get your qualification, and then you join some board membership, I don't know, in what country or whatever, or come to UI.
But yeah, actually, I will join UI in June.
Okay.
Or July.
So there is your answer. That's the next step.
So what do you think is necessary to start something like CFA?
We need a long discussion on this. But CFA is not a bad idea, but it's not the only idea. Any other questions? Every good thing has to come to an end, so this presentation also has come to an end. Thank you very much. I will be here for another 20-25 minutes. If you have your personal questions, we can discuss them to give you advice. Thank you very much for coming. See you around. Thank you very much. That was a nice clap.